Hey everyone, it is Evan here from the Trade Risk on Friday, December 21st, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. So markets got completely annihilated this week, down almost approaching double digits in some of the major averages, which is pretty incredible here. 7-8% declines across all of the Dow Jones, S&P 500, Russell 2000, and the Qs. We are heading into the final trading sessions of the calendar year. We are closed on Tuesday for Christmas. We have a half day on Friday. A half day on Monday coming up this coming Monday. So we have a total of 4.5 trading days left in this year, and there is basically a scramble to get out of this market. It is a rush for the exit door right now. We're just seeing compounding kind of headline fear and just liquidations pretty much across the board here, really pushing down price. I was going to list a handful of oversold metrics for this video, but it's basically anything you look at right now is quote oversold, and in many cases multiple standard deviations oversold, things we haven't seen since the great financial crisis in a lot of cases, of the magnitude of the selling and just the poor breath out there across the market. It is pretty outstanding to see the amount of selling that has come in so swiftly and quickly, but this is what we have, and we're going to look at some of the levels in just a moment. When we look here at some of the technicals, it's just basically a sea of red, of course. Sector performance, 11% down on biotech in the past 5 days. Energy's close behind it. Tech now really getting hit. Semiconductors were resilient. They're still, on the 5 day, they're still sort of hanging in there, but still they were trying to hold at least a little bit firm earlier in the weeks at the start of the selling over the past week or two, but they have succumbed to the pressure, and it's basically right down the board here. Looks like utilities and materials, surprisingly, in the sort of relative performance candidates here at the top of the list, still down 5%. When we look at some of the major assets, it's just volatility. That's what's really roaring higher here. VIX up 40% in the past 5 days, followed by TLT and GLD, your safety haven assets, which money will rotate into times of crisis. So TLT, GLD, those are green, and pretty much everything else across the board is red, down, and getting selling. So let's take a look here at the price action, the charts, the S&P 500. This is the weekly time frame. We're down 7%, almost exactly here in the cash market. Couple of things to note for this week, or for this session, is one, we did have ex-dividend on the SPY here today on Friday. So if we look at a SPY chart, for instance, it's going to show a little further down. So 6.98% down in the cash, 7.62% in the SPY ETF. So looking at these candlesticks, you're probably not going to really notice the difference because the magnitude of range here is so high. But we did go ex-dividend on Friday, so those charts are skewed a little bit to the downside in the SPY ETF. We also had quadruple witching on Friday, so maybe people will chalk a lot of the accelerated selling here into the close to that. Means we just had an extra set of contracts, option contracts, premium, expiring today on Friday, so there was that to play some games with the market as well. So there's really a lot going on, and of course we got the holidays coming up. Could be a lot of books wrapping up here this Friday before the holiday vacation, if you got some of the institutional players taking that vacation, taking that last week of the year off. A lot of them wrapping up books, selling. Again, it's speculation, don't really have any clear insight into that, but there's a lot of reasons which goes to sort of explain the acceleration that we've seen this week. But regardless, here we are, and when we look at the price action, you can see we really did accelerate as we started to break down through the prior year-to-date lows in the S&P 500. Those were around 25.33. At the beginning of this week, we were dancing right on that level. So when we will go down to the daily chart here, when we did our midweek video on Tuesday, right in here, we actually held Monday's lows, and we were dancing right on top of the prior year-to-date lows in front of the Fed, right prior to the Fed announcement. And we talked about in our midweek video that, look, this is going to be the important area if you want to see this market hold this range. If we do think we can go sideways in this range here, this is where you're going to want to see buyers step up aggressively. Maybe, we talked about the scenario of maybe an overshoot to 2,500. We've clearly, an overshoot would be an understatement at this point. But we said, look for that head fake down to maybe 2,500 and then that quick reversal. It never happened, right? We just totally kind of sank lower, continued the selling pressure, and we really just haven't seen a good uptick here in many days now. We did have prior to the Fed on Wednesday, we had this little flare up here. So this was even before the Fed announcement of the raising of rates. We did have the market trying to inch higher here, but once the news came out and market started to digest, we just ended up selling off, taking out the lows, and then that paved the way for Thursday and Friday to just see continued selling below the new year-to-date lows. So when we look here at the S&P 500 on the weekly time frame, we are in clear sort of pullback state. Maybe an understatement. Many may just consider this the panic state or the real fear creeping in. Like I said at the top of the video, we are oversold on just about every metric. If we looked at, the distance between some of the short-term moving averages, we are very stretched, multiple standard deviations stretched to the downside now. So yes, a snapback is likely to occur at anybody's guess, but the problem is the timing of it, because we could get the snapback starting next week. We could get a move down to 2,300, 23 and change before we get a nice violent kind of snapback where the market takes its breath. Maybe it happens next year, at the start of 2019, but at this point, with markets in basically free fall here, it is still punishing anyone that is early to step in here and buy the dip. So you do need to be very, very cautious here. It is, a rubber band scenario, but you do need to be able to remain solvent if you are trying to catch this and jump in here before, before getting any price confirmation. If I look at prior levels here, I think this is where maybe some fibs can come in if you're a fan of fibs. We do have, this is a level here. We closed right at it into this 2,400 area, but you can see there was a bunch of chop in here and the market's finding some support and some buyers stepping in mid-2017, right above this 2,400 area, 2,415 or so. And then you get another sort of horizontal level that we could take a look at right around 2,330. These are levels that are old. They're from 2017, the beginning and mid of that year. But those are some price levels, maybe has some memory there to pay attention to. If you're a fan of fibs, if we look at, I believe I think these are the election lows right here. And if we project, or if we look at the retracement from the lows to the highs of the year made just, several months ago, we are right at that sort of golden ratio that I know a lot of fib traders like to look at, the 61.8%. We also do have some price structure here. So maybe this is where we can find the market to at least pause the free fall that it's in and stage some type of relief rally here. The one thing to note about a relief rally at this point is given the fact that we've just fallen so fast, so hard, this market can easily rally back up to 2,600. This could put in almost a 10% rally back up to 2,600, and you'd still have a suspect market. You'd still have a structurally difficult market to look at here in terms of trend. It's not a comfortable, easy buy the dip market anymore, if that's not clear enough, kind of stating the obvious, but we could get a good sizable rally in place, and we still have plenty of structural damage to ahead of us and to think about and to have risk basically against us. So it's going to take some time for this market to repair what has sort of unfolded here over the past 3 weeks, and the point at which this market does reverse on a dime and start to bounce, we do need to be, again, still pretty mindful and tactical that that could just be a short covering sort of bear market rally that will have some kind of reload sellers back into it if we start to get back up to those 2,600 areas. So lots to chew on there. Ultimately, we are basically in free fall now. We're waiting for the market to catch its breath. One of the things that I'd be looking at for, if we just look at the S&P 500 right now, is, at least to see some stabilization. I generally like to say let's wait for, or let's look for, price to take out the prior day's highs. And at this point, I'm happy enough with just let's see if we can hold on to the last day's lows. Right? We haven't been able to take, since the FOMC, since Wednesday, since the selling really accelerated. Notice we've just been taking out the prior day's lows each and every day. So at least let's look for a pause there. Let's look for maybe Monday. It's a half day. Let's maybe see if we can stage an inside session and start to hold and move sideways a little bit from from Friday's lows here. So that'd be one clue as to maybe when the bulk of the selling pressure has been lifted. Otherwise you could look at this accelerated trend line right here that we've been very, very steep. It's almost a straight line there to the downside, but that would be your next level or your next sort of set of clues. Is one is hold the prior day's lows. Number two, maybe break this trend line. Three would be rally above a prior day's highs. Those are sort of the the incremental steps that the worst of the selling, or at least a temporary relief of selling, is in fact over. Until and if those start to happen, we could just continue in free fall a little bit further. So that's really the way I would be looking at this, to see when things can start to stabilize. Otherwise, it's just essentially protecting yourself, being cautious, and again, dip buyers that are early here are just getting punished into this decline. So that's really the S&P 500. That's kind of how I'm looking at it here. If we do start to rally, again, talked about that accelerated trend line, talked about the prior day's highs here, 25.33, again, that is the prior year-to-date lows. Let's pay attention to it. Again, that's far away from where we are right now, but, looking back in hindsight, if you got this monthly candle that all of a sudden staged a big tail down here and we closed above 25.33, maybe that's notable. Again, I'm really trying to, pull for the silver linings of maybe a potential bull case there. I don't say that that's the high probability scenario at this point, but it pays and helps to keep an open mind of what could happen here. So I think that's basically it for the S&P 500. I don't know what else to say in terms of levels. When you're in free fall here, again, we can look at those fibs and look at some of those early 2017 levels to pay attention to. Otherwise, I'd start to dial it down to an intraday chart and start looking at some of the nearby levels, because they are in percentage terms now getting pretty far away from each other, even on an intraday basis, given the fact that ranges have picked up so much. So when we go to the IWM, this is really where this is the scene of the crime firsthand. When we look at the yearly chart now, it is quite incredible to see we're down 16% in the small caps. We've totally taken out last year's lows, and we are back into almost 2015 range. So we had a high of 129.10 in 2015. We are at 128. So we effectively are back to levels that we did trade in 2015 for the Russell 2000. It is an outside reversal year for the Russell 2000. No, if you look at a yearly chart, again, these levels would not be precise, but you're kind of coming back into trend here. Maybe you got even a little bit further to capitulate down into the mid 120s before the real kind of relief starts. If we look at a daily chart, really a weekly chart, and we zoom back here, 2016, 2015 area, this is where we had the big breakout in the market from that sideways range. We're almost back to retesting those levels now. We've put in a good sizable pullback. If we put a retracement on here from the 2016 lows, again, not the election lows, but just the lows from 2016, you can see we're in between that slot, almost a 61.8% of the full 2016 bottom to recent highs several months ago. So lots and lots and lots of damage there in the Russell 2000. Essentially a straight line down. Very high volume this week. Extremely oversold. Tactical players here are going to be interested in the Russell, the Qs. I mean, everything's in play right now for the indices, but extremely oversold. But it is in free fall, so you do have to be careful there. Qs. This was sort of the standout for the major markets here, that the Qs were holding up best in class. That basically, I mean, it changed in the sense that we are finally getting the real selling pressure to come through the Nasdaq Composite, 8.39% in the Nasdaq 100 to the downside this week. Heavy volume back to 146. Notice we are still, on a relative basis, we're still kind of up in here around the late 2017 levels. So compared to the Russell 2000, this is doing much better. Still, though, from a technical perspective, in the short to midterm, it's in a real tough spot. So, the levels right in here, this 146 slot, this was where we broke out from in October of 2017. We're retesting it right now. Good short-term level to pay attention to. Again, extremely oversold, but you have to be careful in these free fall scenarios. So that, I think, covers everything I wanted to say about the market environment. A little bit long this week, but deservingly so at all of what has unfolded before us here. And I think that's it. Looking at my notes, I think that's everything I want to go through. So let's go through now some of the major markets, some of the other major assets. TLT up 1.89% this week, almost back to the top end of this range here. This happened really fast as well. Remember, just a couple weeks ago, we broke back above this 117 level. That was long-term support. That was a long-term inflection point. That got us, encouraging, or at least notable sort of rally here by the bulls. Once we reclaim this level of 117, now we're right back to the top end of this range. It is stretched here in the short term, but this trend is strong, so it's just the inverse of the equity markets where it's tough to want to fight it. It is overbought here, but this is where we're seeing some rotation based on Fed speak, based on just the fact that the long treasury bonds here tend to be a safety haven in terms of in terms of equity turmoil. So TLT looking good there, over, running into resistance though, so I wouldn't want to necessarily be a new buyer right now, but the trend is to the upside there in the short term. GLD next, which continues to work itself higher. You can see almost tagging, if you projected the slope of the top end of this trend line here out, kind of tag that, pulled off just a little bit. Again, tough to be a buyer right here, but bulls are in control, so until that changes, I got to respect the trend there for GLD and the qualities that make it attractive when everything else is melting down. Silver is still sideways and range bound here. That's fine. $14 to $13. That's where it's been moving since August, and it is fueling up for a big move coming next year. Doesn't look like it's ready to move just yet. Some good volume coming in recently, but looks like it's kind of stalling up here at the top end of its range. We look at oil on the week here, and down 11%. So again, really just a total free fall here in USO as well, down 41% in the past, let's see, how many bars is this? In the past a little over 2 months, we're down almost 40% in the USO ETF. So some pretty outstanding capitulation and rotation out of USO right now. Of course, the dollar's been strong, and a lot of other factors macro-wise that has been, kind of supporting this, but it is still pretty remarkable, extremely oversold on lots of metrics. Again, whatever you want to look at here, pretty sharp move and indicative of bounce-like behavior, but the timing of it is what's going to require some patience and some intraday chart studying. Natural gas this week here did manage to just about stabilize, close down 1.63%. It did start to sell off pretty aggressively at the start of the week, but it did catch a little bit of bid. Volume has tapered off here, but we look at a daily chart now. This might just be a flag for a second leg lower, or we're back to kind of get back up and retest these levels here. To me, not really interesting right now. The ranges are expanded, so for you, traders looking for things in play, I think everything's in play at this point, but natural gas might be interesting. Swing perspective, I'm not so interested in it. And I think that's it. I think those are all the major assets I wanted to cover. So let's take a look at sectors here. It's basically going to be carnage right across the board, but if we do look at some things that are trying to hold up well, surprise is XLU, is utilities. So top performing sector this week. You can see if we look here at maybe this weekly trend line where this could start to find some support. It is slicing through it right now. Let's keep an eye out for that potential overshoot of this area, but if it does get that confirmation follow through next week, you can see the volume's real high. This is going to be in tough shape. Individual names are still how I like to pay attention to that pay attention to that sector other than just the XLU outright. Materials here was the second best performer this week, but there's really nothing to like here at all. Still a high volume breakdown to new year-to-date lows, looking like even a more complete kind of topping pattern than maybe some of the other major markets. And more concerning is the fact that we are back down to 2014 levels. So the highs made in 2014, 2015 in the material ETF is now being lost, and we are kind of falling back into this old range and high volume. So really nothing to like there. And financials, which is a critical component of the S&P 500 and financial markets in general, is running right back into this area here, this 23 level, which is very important. This is where we found a lot of support, kind of printed this head and shoulders pattern, if you want to call it that, back in early 2017. That never materialized, turned into a continuation pattern, but there was a lot of kind of demand coming in here and support stepping in around that 23 area. We're back to it now. We're in fact overshooting it. Let's look for that snapback again, that undercut and snapback here for some real extreme oversold rubber band kind of snapback scenario. I think that's an interesting play if you're very tactical. I mean, otherwise the setup looks, this area, this sector of the market just looks horrid. So it would be for a trade, but something to keep on mind. IBB finally breaking through that 101-100 level. Remember, before the 3-to-1 split, this was the dreaded or the infamous sort of 300 level. But this thing had been tested so many times over the past year and a half or so, and it finally gave way this week in very big fashion, 11% to the downside. Volume 2x daily or 2x weekly average here. Surprised it wasn't higher, to be honest with you, given the magnitude of this move and just all of kind of the levels in here. But this thing clearly in breakdown mode right now, meltdown mode, so nothing to like there. Energy also back down to mid 2016 areas. So remember, we had the very huge slide with crude falling down to, God, I can't even remember. I forget how low a barrel it was back in 2016. But when we had that real big meltdown from 2014, 2015 in energy, we're getting almost back to those levels. We're not far off now from about 10, 15, 20% from the 2016 lows. You got to imagine maybe we're back to retest some of those levels in the energy space there. And finally, we have XLY. We get consumer discretionary, was the third worst performing this week, 8.37% to the downside. We're almost back to this 2017 consolidation here, kind of retesting this breakdown. Not a healthy way to retest it. We're certainly stretched here going down into it, but 92.50 or so, let's pay attention to that. That was the prior breakout level that we can reference here. Lots of these sectors, when we look at the individual components here, are in this kind of have the potential for this snapback kind of rubber band play, overshooting some prior very important levels. And then if we do get that quick reversal, again, everything would be for a trade because we do have tremendous damage there. And again, it all depends on your strategy, time frame, et cetera, et cetera. But those are some of the things that I'd be looking at myself, heading into really 2019 at this point. So that is it. A little bit longer this week, but there was lots to cover. Hopefully everybody was sort of protected and didn't get too pummeled this week. And if you did, hopefully it's a learning experience, and it's something that you don't repeat in the future. But it is a tough week out there, tough way to finish out the year, tough for right before the holidays, but maybe there'll be some light at the end of the tunnel. At least Tuesday, the markets are closed. The markets can't go down on Tuesday, so maybe that'll be our best day of the year remaining, is when markets are flat and closed on Tuesday because the sellers can't sell. That is it. Thanks so much, as always, for watching every Tuesday and Friday. You can subscribe to us on YouTube or check out the Trade Risk blog. Every Tuesday and Friday, market recap videos posted like this. Enjoy the holidays. No video on Tuesday this coming week, but we'll be back later in the week on Friday. Thanks so much. Have a great weekend. Talk to you next time.